You saved for years. You have your down payment. You found the house. Your offer got accepted. And then 2 weeks before closing, your lender sends you a document called the closing disclosure. And on the last page, there is a number you weren't expecting. $8,000, $11,000, $14,000, due at closing, in addition to your down payment. This is the moment that derails more first-time home purchases than almost anything else. Not the market, not the mortgage. A number that was always going to be there that nobody ever clearly explained. This video exists so that doesn't happen to you. Closing costs are the fees and expenses required to finalize a real estate transaction. They're paid at the closing table, the meeting where ownership legally transfers from seller to buyer. They're separate from your down payment and they are not optional. They typically range from 2% to 5% of the loan amount. On a $300,000 home, that is $6,000 to $15,000, depending on your location, your lender, and the specifics of your transaction. Here is why most first-time buyers are blindsided by this number. When people budget for a home purchase, they think about the down payment, which feels large and concrete, and the monthly payment, which they run through a calculator. Closing costs don't fit neatly into either category. They're a one-time lump sum that arrives late in the process when your attention is on the finish line rather than the math. Closing costs fall into two categories. Lender fees are charges from your mortgage company for processing and originating your loan. Third-party fees are charges from service providers involved in the transaction, the title company, the appraiser, the attorney in states that require one, the government recording the deed change. You pay both. Let me go through every line item so there are no surprises. Origination fee. This is the lender's charge for creating your loan. It is often expressed as a percentage of the loan amount, typically 0.5 to 1%. On a $280,000 loan, that's $1,400 to $2,800. Discount points, optional but worth understanding. 1 point equals 1% of the loan amount paid up front in exchange for a lower interest rate. Whether buying points make sense depends on how long you plan to stay in the home and what the break-even timeline looks like. Appraisal fee. Your lender requires an independent appraisal to confirm the home is worth what you are paying. Typically $350 to $600 depending on the property and market. Credit report fee. Small, usually $30 to $50. The lender charges you for pulling your credit. Title search and title insurance. The title company researches the property's ownership history to confirm the seller legally owns it and there are no liens or claims against it. Title insurance protects you and your lender if a problem surfaces later. Expect $500 to $2,000 depending on the home price and state. Escrow or attorney fees. In some states, attorneys are required to handle closings. In others, title companies handle it. Expect $500 to $1,500. Prepaid interest. You pay interest from your closing date to the end of that month. If you close on the 15th, you pay 15 days of interest. On a $280,000 loan at 6.8%, that is roughly $320 a day. Closing earlier in the month costs more upfront but reduces your first mortgage payment timeline. Homeowners insurance prepayment. Lenders require proof of insurance and typically require you to prepay the first year at closing. Expect $1,200 to $3,000, depending on location and coverage. Property tax escrow. Lenders typically collect 2 to 3 months of property taxes at closing to establish your escrow account. On a home with annual taxes of $4,000, that is $660 to $1,000 up front. Recording fees. The local government charges a fee to record the deed change in public records. Typically $50 to $250. Transfer taxes. Some states and counties charge a tax on the transfer of real property. This varies enormously. Some states have none. Others charge up to 2% of the sale price. You know your state's rules before you budget. Closing costs are not a fixed number. They're negotiable and reducible in ways most first-time buyers never explore. The first strategy is lender shopping specifically for fees. Interest rate comparisons get all the attention, but lender origination fees vary significantly. A lender offering a slightly higher rate with dramatically lower origination fees can be the better deal depending on your timeline. Get a loan estimate from at least 3 lenders and compare the fees column, not just the rate. The second strategy is seller concessions. In a balanced or buyer-favorable market, you can ask the seller to contribute toward your closing costs as part of the purchase negotiation. This is called a seller credit or seller concession. The seller agrees to pay a portion of your closing costs out of their proceeds at closing. You effectively roll the closing costs into the negotiated purchase price or receive a credit that reduces what you bring to the table. The third strategy is a no closing cost mortgage. Some lenders offer to cover your closing costs in exchange for a slightly higher interest rate. The costs are not eliminated, they are rolled into the rate you pay over time. For a buyer with limited cash reserves who can't cover both a down payment and closing costs, this can make the transaction possible. For a buyer who plans to stay in the home long term, the higher rate is usually the more expensive option over time. The fourth strategy is timing your close date. Closing at the end of the month minimizes the prepaid interest you owe at closing because you're only paying interest for a few days rather than most of the month on a large loan. This can save $200 to $500 in upfront costs. The fifth strategy is reviewing your loan estimate carefully. Your lender is required to provide a loan estimate within 3 business days of your application. Review every line item. Some fees are fixed, government recording fees, transfer taxes. Some fees are negotiable, title insurance, settlement services. You have the right to shop for your own title company and settlement services in most states, which can save several $100s. This scenario is more common than people admit, and there are legitimate paths through it. Down payment assistance programs in most states include closing cost assistance. Many of the state housing finance agency programs we have covered previously provide funds that can be applied to either down payment or closing costs or both. If you're using one of these programs, ask your loan officer specifically how much of the assistance can be directed toward closing costs. Gift funds are allowed for closing costs under most loan programs. If a family member is willing to provide a financial gift, not a loan, toward your closing costs, FHA and conventional loans allow this with proper documentation. The donor will need to provide a gift letter stating the funds are not expected to be repaid. Rolling closing costs into the loan is possible with certain products. VA loans allow closing costs to be rolled into the loan amount under specific conditions. Some renovation loan products also allow this. Ask your lender what is allowable under your specific loan type. Finally, negotiate. In a market where homes are sitting longer and sellers are motivated, a seller credit toward closing costs is a reasonable ask. A seller who gets their price may be willing to help with your costs to keep the deal together. Closing costs are not a surprise if you know they are coming. They're a predictable, itemized, partially negotiable set of fees that finalize a real estate transaction. The buyers who get blindsided are the ones nobody told. Now, you're not one of them. Budget 2 to 5% of your loan amount for closing costs on top of your down payment. Get your loan estimate from multiple lenders and compare the fee columns. Ask about seller concessions during negotiation. And read your closing disclosure line by line before you sit down at the closing table. The number on that last page doesn't have to be a surprise. It's just math. And now you know how to run it.